From Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Juliette Sarli on this Thursday when we were seeing a solid fifth session of gains. Then the miners started to get a little bit of a wobble. Let's have a look at where we are tracking as we close out the day's trade. Pretty flat there on the CBO 200, up just 2 points. The ASX 200 only marginally higher as well, up by 10 points, a tenth of 1%, 7,860. So importantly, a fifth day of gains, but you can certainly start to see where some of the selling happened in the afternoon trade as we started to get that data out of China, iron ore prices falling and weighing down a lot of those miners. So the three themes of the day, of course, really just about this mixed earnings picture that we're looking at. We saw the likes of Telstra coming through with its numbers. It did increase its dividend and the market seemed to be okay with its result. But then on the other hand, you had Cochlear kind of missing the mark when it came to its forecast, and that sent shares down quite heavily today. I spoke to the CEO a little earlier. Of course, in true CEO fashion, they're not watching the day-to-day share price move, but very much focusing on the year ahead and still forecasting on growth of about 6 to 11%. The other news of the day was, of course, the jobs data. Look, always a really patchy one, but Michelle Bullock made it very clear last week that the RBA does not want to, or cannot see a reason, I should say, to cut interest rates anytime soon. And Deutsche Bank's Phil O'Donoghue talked to me straight after these numbers came through saying, look, this is just going to keep the RBA hawkish because on the one hand, you did see a big jump in the number of people who gained employment in July, 58,000 jobs created versus expectations of 20,000. But you look under the hood at the participation rate, it's a record high of 67.1%. So that means that there are a lot of people out there looking for jobs, and we actually saw the unemployment rate tick up to 4.2%. Still a tight labour market when you look comparatively to pre-COVID, but as Phil O'Donoghue says, doesn't think that that's going to give the RBA much of a reason to look at cutting rates. Also, the China data dump coming through, really showing that the economy has failed to pick up after its worst stretch in 5 quarters. You've got industrial output and retail sales broadly in line with what the market was looking for. But of course, these worries about China's housing slump very much remaining a drag, particularly when it comes to consumer spending. Let's have a look at the sectors of the day locally today, kicking it off with the miners, which really got hit hard by this drag down in the iron ore price. Fortescue, which fell about 5% yesterday, down another 2.5% today. Rio Tinto down almost 4%. BHP was down by more than 1%. In the healthcare space, of course, Cochlear's results weighing heavily on that overall sector, falling by 6.7%. I did ask Dig Howard if he thinks the stock is too pricey, like a lot of analysts say, but of course in true CEO fashion as well. He's been media trained well. He did not comment on the dynamics of the market. The telcos, having a look at Telstra after its numbers, up 2.5%, really on the back of the fact that it did increase its dividend there, and certainly a front runner in that space. And just keeping an eye on Telstra, net profit did slide, and that was mainly due to higher operating costs. But as I mentioned, they are going to pay a dividend of 9 cents, bringing total dividends to 18 cents a share. Magellan had a good day. It says it's going to take a stake in Vinva Investments. It reported profits for the year. Treasury Wine Estates, Andrew spoke to the CEO there. They lifted their final dividend payout. It's really interesting as well. What he was saying was that due to the health and wellness movement that we're all getting on board with, people are drinking less, but they're drinking more expensive wine. And Origin Energy shares fell by more than 9% after its numbers, while Goodman Group did beat the street with its earnings guidance, but shares still sold off by 0.8%. Let's get across the market day and what's on his radar as well. Jimmy Jang from Macro Capital. Jimmy, how are you sort of seeing reporting season play out so far?
Afternoon, Juliet. No, definitely a lot of movements is happening in the market, especially with some of the key data that was released today, the unemployment rate as well. Look, in the broad sector, we obviously had the tech really kind of stand out, largely driven by the advancements of the AI and the digital transformation initiative. Obviously, the sector is up, close to about 30% over the last let's say 12 months, really underpinned by the strong earnings from companies like WiseTech, Xero, etc. So, the companies have really benefited from their ability to leverage AI to enhance their product offerings and their streamline operations as well. One of the key stocks that we had to look very closely with a lot of our dear clients' favorite stocks like Origin really fell, really with the disappointing efforts. So obviously the producer warned of a real huge decline in the electricity profits due to the lower wholesale costs and the reduced retail margins as well. So look, overall, the market reaction has been very cautious, as we have seen over the last couple of weeks, even despite the reports start to come out. Really investors are closely scrutinizing the earnings reports and the forward guidance. So the mixed performance across different sectors really reflects broader economic uncertainties and the varying industry dynamics. So the investors are, really particularly focused on how companies are navigating those rising costs, geopolitical risk, and obviously the ongoing technical disruption as well. So we're very cautious ourselves.
All right, well, let's talk about some of the big names. I mean, you mentioned Origin there, but CBA yesterday, look, it beat what the market was looking for, even though its profit was lower. A couple of people saying CBA is looking like a growth stock.
Look, obviously they reported close to like 12% increase in their net profit to about $10.2 billion, really driven by their strong lending growth and, their improved net interest margins as well. But it'll be kind of interesting to see how the performance of the CBA will be in the future, in the next 6 to 12 months, for example. With, as you have just mentioned, Juliet, the RBA have made it very clear that there won't be any rate cuts happening anytime soon. Potentially the rate cut hike in Australia, contrary to the US, is something that we might potentially see here domestically. So, we'll be kind of seeing how the lending exposure, the CBA, or not just CBA, perhaps in the other big four banks as well, will be adapting to that. So probably in our perspective, we probably won't buy anything in the CBA right now just because of how they're valued in terms of their profit. We kind of have a view that it might be a little bit more inflated than ideally what we like. Probably the $100 to $110 mark is what we prefer.
Okay, what about the likes of JB Hi-Fi? And that sort of surprised the market. And I guess a lot of that to do with that special dividend as well.
Yeah, I mean, look, their company has recorded a slight decrease in their total sales by about 0.4%. But one of the things that was quite notable was their significant drop in their NPAT. So despite this, the market really, as you mentioned, the special dividend, that was something market has really adapted positively. But it's also the company's strong performance in the key categories like the strategic acquisitions and the better than expected full year dividend, as you mentioned. So overall, JB Hi-Fi is in a really strong position, especially with the potential new phones coming up in the different facilities as well. So yeah, we like the JB Hi-Fi. We've been kind of monitoring that for the time being. Probably a little bit a late stage for us to get into it, but probably good to still monitor it right now.
Okay, let's talk broadly as well about the macro picture. You're from macro with a Q, but let's talk macro with a C. We had the unemployment rate tick up, 58,000 jobs created. Make it make sense.
No, I mean, look, the consensus was the 20,000 jobs being created, and obviously the unemployment to steady at 4.1, but we saw the 4.2, which is, what it kind of, raises a little bit more questions to the RBA. I mean, what the RBA would like to see, that's the question the market is really throwing up. Especially with the economy, barely grew in the second quarter in Australia, although there were signs of strength in consumer spending after some upwards revisions, really indicating that economic growth have subsidized enough for the RBA to hold rates steady rather than a rate hike. So it's a very volatile time frame, especially for the RBA to really consider, because in one hand, RBA wants to control the inflation, but on the other, we see other global markets like US really trying to cut rate aggressively as well. So it'll be an interesting time frame.
Interesting time frame indeed, and interesting times in general. All right, look at some of the stocks that Macro's looking at. You're topping up Cleanaway Waste Management. What do you like here?
Look, we've been kind of getting into Cleanaway Waste Management for close to about a month now. A really good outcome, but in terms of the uncertainties that the market is presenting, what you will slowly see in the market is all those dividend or growth dividend focused companies like APA Group, for example, will start to really do well. And on top of that, the sectors like industrial, like Cleanaway Waste Management, where it's not going to be, the performance of Cleanaway Waste Management is not going to be too volatile depending on how the economy economy is running. So, clean away waste management, where it's a lot more defensive in nature to really project that or kind of hedge against the volatility that the market will be offering in the immediate 6 to 12 months, is definitely what we did prefer. And now with these uncertainties even coming forward even further, we would like to increase our exposure in the clean away waste management.
All right, an interesting one. Looks like a very interesting chart when you look at the longer term as well. We're looking very closely at bonds in the US in terms of these projected rate cuts from the Fed come September. What do you see in terms of like structured products to take advantage of this?
Yeah, I mean, look, it's almost a certainty that we're going to see a rate cut over in the US in the next meeting in September. There's also about 35% probability of a 50 basis point rate cut. So there's a two sides of a story where the Fed might start to cut 50 basis point and see an even more aggressive rate cuts throughout the remainder of this year. So rather than, getting involved in equities where it'll be a lot more largely short-term driven by the market, we actually like to get a long exposure or a geared exposure through a structured product. So we just gone live with a structured product where we're getting a leveraged exposure on the performance of a global PINCO income fund, where largely majority of their assets are in the 2, 10, and a 30-year US Treasury bonds, so not in Australia, where the investors are achieving close to, let's say, 10 to 12% in interest payments straight away if the Fed cuts rate by any basis point by end of this year, which we have a very high conviction that will be happening, and also the leverage exposure on the performance of the bond until August next year, where if the performance of the fund goes up by, let's say, 5 to 10% with the market sentiment of 125 to about 150 basis point rate cut in the US, then the investors could really enjoy that 7 to 10% upside on a leverage exposure on this bond. So that's probably what we prefer, where it brings a lot more high certainty than to our investors.
All right, always a pleasure, Jimmy. Enjoy the rest of your week. We've got one more day left, don't we? I can never remember what day we're up to. That's Jimmy Jang from Macro. All right, the stock of the day was Cochlear. Andrew spoke to Mark Gardner from MPC Markets, and he was also joined by Henry Jennings from Marcus Today.
A little bit savage, I would say overall, but here we are, just sort of sitting at pretty key levels for the calendar year. Be interesting to see what the broker upgrades the broker moves are tomorrow. And but it wasn't a horrible result. I think it was just more market valuation, and it'll still be probably a long-term hold.
And I think there's probably more downside to come in this one when the brokers start talking it. There was a $75 million buyback, which obviously gives it some kind of underpinning and some support. And it is a great Australian success story. So it is almost un-Australian to put a sell on it. So I'll say it's a hold. But if you're coming to this as a new investor, I think there's probably better opportunities elsewhere.
Better opportunities elsewhere, according to Henry, who was on fire today, actually, because he spoke to Andrew earlier as well, talking about CBA, saying, look, it is expensive, but so is a Rolex. You can find that online as well. Let's have a look at the market leaders. NRW Holdings up more than 10%. Magellan, we mentioned, had an update. Net Wealth and Pro Medicus, they've already reported, doing very well. Emerald Resources up 4%. Looking at some of the laggards today, New Farm after its numbers, along with Origin and Cochlear, which we've touched on, along with Stanmore Resources and Whitehaven Coal, also coming under pressure today. In the small end of town, we saw a 46% gain from Latin Resources. WI Gold, Fiducian, I talked to the CEO, Indy Singh, you can find that up online. He was saying, look, they're about 10 times below what a lot of their peers are valued at. So obviously he sees a lot more upside to the share price. To the downside, in the small end of town, Phoenix Resources down almost 10%, Aspire Mining, Empire Energy, Pan Continental Energy and Titomic. Having a look at what we are focusing in on tonight, of course, it's those retail sales after we had the inflation data already. So this will be another key for the Fed. But of course, all these expectations now, we will see the Fed cut next month. Unemployment claims, those weekly ones, a Philly Fed manufacturing index, industrial production, and a read on the housing market as well in the US. Looking ahead tomorrow, we have the RBA governor appearing before a House of Representatives Standing Committee on Economics, and a lot of earnings as well. The ones that we'll be focusing in a lot on are the likes of Amcor, ASX, Domain Holdings. We're going to be talking to the CEO, G8 Education, GQG Partners. Homeco Daily Needs REIT has already reported. Yesterday we did speak to the CEO, but we will get an update as well on the likes of Mass Group and Objective Corp as well. All right, that does it for today. Let's have a quick look at where the market is tracking now. We are up just 2 points there on the CIBO 200. The ASX 200 up 10 points, 0.1%, 7,860 points. So really did manage to finish higher for a fifth day, but that weakness in iron ore and in China dragging down the miners, and of course Cochlear, as we mentioned, dragging down the healthcare sector as well. But another busy day ahead tomorrow. Join us from 9:45 Eastern for all the overnight market action and of course a bunch of more CEO and earnings reports from the ASX.